Chinese banks are quite well placed, and that is something which sort of seems to keep a lid, as it were, on these kind of issues, and they have kept a lid on this issue for quite a while. And I think if I really contrast that to India, I think if you really look at the relative level of transparency, I think on a relative basis we are far superior in terms of the issues facing our banking system, both in terms of the absolute non-performing assets as well as what one can call as weak assets, which are restructured and so on and so forth. There are enough and more data estimates. Someone can say that there is something further, which is standard assets, which are actually weak assets, which some of you may have also been reading about the power projects, which are delayed for a period of 2 years beyond COD. But the point I'm trying to make is, I think the issue in India is things are far clearer, but the ability, especially of the government, to capitalize the Indian banks is something which is a concern. So if I have to really, contrast and compare, China and India, I am not seeing a situation, first of all, that we will see any full-blown crisis on the Chinese banking system. And given the issues that I would look at in terms of the strengths that China brings vis-a-vis where we stand in India, I think it's going to be fairly even, Steven, with maybe a slight bias towards the other emerging markets. And I think, but that's not very, very substantial. So I'm not really seeing a sort of huge, as it were, flight away from risk in China to other emerging markets. So it at best will be a very slow, gradual transition to some extent. But China is too large an economy and too dynamic for the markets to ignore. So that's really how we will see China and the relative position of other emerging markets.
Okay. So let's now come to the Indian markets and try to see the opportunities in India. So I think at the last count, the investments by FIIs in the Indian fixed income space was about $42 billion, out of which about $16.5 billion has come this year. So my question is to Amit, is whether this is an yield play, or it's a currency play, or it's is the Modi effect?
So I guess the good work as far as India is concerned started a year back. What we are seeing right now is a combination of the good work that has happened in the last 1 year in terms of improvement in macro factors, as well as a lot of positive anticipation in terms of the fact that we are not only on the right path, but the measures will in fact accelerate what we are seeing right now. So just in terms of numbers, a lot of people talk about the improvement, for example, in the current account deficit. People talk about stabilization or stability as far as core CPI inflation is concerned, etc., etc. So I think this is much more structural from that perspective. And if I actually look at it from a FII perspective, the fact of the matter is the last time we had a rally almost 10 years back, it was exactly the same structural story that we are likely to witness this time around. It's just that the FII participation at that time, because of regulatory reasons, was not there. So that is the only difference. As far as interest in the markets is concerned, it is equally strong, whether it is domestic investors or FII investors. It's just that since FII investors are coming in for the first time, that tends to get highlighted. But if you ask me on a broader scale, I think a lot of people are comfortable today in terms of the vastly improved fundamentals that we are looking at right now, and also the promise that these fundamentals are going to improve. So whether you're talking about, see, a lot of people talk about the growth inflation mix, trade-offs, etc., etc. But I guess what is key, what the market is right now focusing on, is that not only are the macro numbers improving, they are improving for the right reasons. So for example, when you talk about growth, so nobody is talking about a 9%, 10% kind of a growth number in India today. People are talking about a 5.5–6% growth, and people are very happy with that, because it is coming for the right reasons and from the right sources. Similarly, in terms of inflation, when people talk about inflation, what everyone is concentrating on is consumer price inflation, which affects everyone on a day-to-day basis, and that also core consumer price inflation, which is the main factor that RBI would be looking at in terms of policy setting. There also we see meaningful improvement, both in terms of slowdown in services inflation as well as in terms of housing inflation. So broadly speaking, I think this is more of a structural story, and that is why people are so positive, including the FII flows that you see right now. So I guess this is going to continue over the next 18 to 24 months at least.
Okay. Last year, I think September was the time when we had rupee going really haywire, and then suddenly there was a lot of discussion of getting more and more money flowing into India, and then there were talks about getting Indian bonds included in some of these global indices which are managed by JP Morgan, Barclays, those kind of names. And my question to you, Dhawal, is what needs to be done by the government to get ourselves included in those indices, whether that's required or not, and what will be a good time for us to be a part of those indexes?
See, the way we understand is that there are certain conditions laid down by these index manufacturers, and JP Morgan is one of the biggest in emerging market bonds. And for us to get into the JP Morgan Emerging Market Bond Index, you need to have an open gate policy, wherein any foreign investor can just walk in, buy as much as they want, and get out at any point of time of their wish. Now, if you understand the Indian fixed income market, it's a closed gate kind of system. On any particular day, if you have a large amount of selling, you will see there is going to be a price impact. And I think both the RBI and the government are cognizant of the fact. What transpired in September, October of 2013 was that we had a massive amount of outflows from the fixed income markets, and India's FX reserve dropped by about $20 billion. So there was an urgent need to bolster the FX reserves, and one of the ways some market participants have suggested was to get India's bonds included into these kind of indices. But if you do a cost-benefit analysis, what comes out very clearly is that it could be a very costly proposition, particularly from the depth perspective, because Indian fixed income market is not very deep. And we have seen in countries like Indonesia, where the FI participation is almost 30% of the total bond, that whenever they come in or get out, it's like bulls in China shop. They just break everything and then go. So then the regulator and the government takes a long time to fix things. So by that point of time, when India had managed to raise about $34 billion through FCNRB and Tier 1 capital through bank borrowing, the need to get ourselves included at such a high cost has diminished. So in nutshell, if you ask me whether we should be part of these global bond indices by keeping the doors open, I have my reservations up until we are able to deepen the secondary market or create a dampening effect that if tomorrow somebody wants to come and sell $1 billion or $2 billion worth of bond, and there are institutions who can absorb them without moving the price. I think that is up to then. I think we should be careful about getting into this kind of situation. What they are also trying to do is to get Indian bonds in Euro-clear system, wherein a market participant can buy bonds in India and get coupon in their country, which I think will be a step in the right direction, because that will perhaps bring in more set of buyers, those who will come within the quota. And I think that is what will be perhaps more important in order to protect the Indian system.
Okay. Sujoy, what else can Sebi, RBI, or the government do to widen the overseas investor base?
Oh, sure. I think they can do several things together, and yes, Sebi, RBI, and government have to jointly work together to improve what I would say the brand equity of India overseas. Nobody knows India. I think in our several rounds of discussion with foreign investors, in order to where we have gone and tried to showcase Indian debt market and trying to pitch a point that Indian debt market could be a compelling investment destination for foreign investors. The point is that Indian currency is not freely tradable. The volume of Indian currency as a percentage of the overall currency trade volumes is minuscule. So if you want to come in and go out, so obviously it's going to be a dangerous proposition if you intend to do it in large numbers. So that needs to go out, number one. Obviously, they need to have an open door policy. While Dhawal says, yeah, obviously it's to be part of the indices, it needs to be there. I think in order to make Indian markets a compelling destination or attractive for a wide range of investors, India needs to be part of indices. Because if you think from an investor's point of view, he probably would try and mimic the benchmark which he has for his own portfolio. So if India doesn't fall part of the benchmark, he probably will just think about it as small alpha position, which might be under 1% or 0.5% or something like that. It will not be a meaningful position. Secondly, I think whether we like it or not, I think India needs to attract foreign investors, because the kind of growth targets that the government is dreaming about and what we are all thinking about, we need to invest a lot of money, and India doesn't have money. The Indian banking system is cash starved. I think that when the economic cycle actually picks up and goes to a level of 5.5–6% growth, the kind of debt capital requirement which will come onto the banking system, we are not prepared to even meet those requirements. So India has to attract foreign investors, till that demand picks up, and India should actually address all those, Secondly, I think the way the piecemeal approach of opening up limits to foreign investors is something that they actually do not enjoy. They want a wide, blackboard, so they can come in, buy securities and go out. I think as long as Indian, the macro fundamentals are robust, the currency is stable, I don't think we should be worried about the kind of, ownership that the foreign investors will have for Indian debt. And clearly, Indian debt ownership by foreign investors is probably the lowest in emerging markets. We are under 4%, whereas certain other countries is upwards of 30, 40, 45% as well. So we are nowhere close to the game, in terms of what the possibilities are. There are tremendous possibilities. In terms of rules and regulations, I think Sebi, they have changed the rules and regulations too often for the foreign investors. Sometimes it even becomes too confusing even for us to understand the rules and regulations which are pertinent at that point in time or applicable for an investor. I think things have to be made far more easier to understand. They have to be long lasting policies. They should not be changed every second or third month. The limits have to be, I think, open for various kinds of, debt asset types. While you would like to have a 3-year plus money coming into the system, I think, yeah, that's, wise decision, but it should be available to all kinds of, investors. You shouldn't have one, bucket of investors for 10 billion and another 20 billion for another kind of investors. And there is always confusion about what to do once you reach those limits. Like very recently, more than 90% of the sovereign debt limits have been utilized. Now people are just waiting for a government to come in and decide whether you would like to open it up further. Obviously, I think the government has to decide and quickly open it up because you need that money. While RBI is dropping the SLR requirement for the banks, you have to create a commensurate demand from foreign investors. So it's an absolute necessity. I think the earlier all of us understand that and open it up and make it a free market for all investors to come in, I think that's when the real, acceptance of Indian debt market will emerge. And then thereafter, I think the wider acceptance from foreign investors will also kick in.
So I think as per the last count, there was somewhere around $200 billion, which was kind of linked to these indices, which we want to be a part of. And as if we do the right things, probably we will be getting a 10% weightage, which means about $20 billion of new money which will come into India.
Absolutely.
So what if we do it over next 6 months? Do you think it will be a good thing to do? $20 billion, will we be able to absorb that kind of money without impacting the market considerably?
I think the way the 20 billion number has come about in our conversation is that there is some 200 billion of emerging market debt money which actually tracks the JP Morgan emerging market bond index actively. So that's around, I think, 220 billion. And the 20 billion has come about from the fact that India probably will command a 10% weight in the JP Morgan index, from the simple point that there are markets of equal or lower market capitalization of India's status who have a 10% weightage in that index. So if India has to be part of it with about 700 billion GSEC market cap, whereas Brazil is probably under 600 who has a 10% weight, so India will be probably attracting 22 billion. Now the 22 billion can be absorbed. Obviously it can be absorbed. The amount of debt which is issued by Indian government and corporate bond corporate India put together is far higher than the 22 billion. So the 22 billion probably will possibly come into government securities, and will it mean good for our system? I think it will mean good for our system. Only the issue is that we always fear is that once that money comes out, what will happen to us when that money goes out? So when does money go out? Money goes out when you become, an attractive investment destination. Obviously, money doesn't come in to stay forever, but if you are attractive enough forever, then it will stay together forever. So, I really do not see actually any harm in case it's opened up and we are in a position to attract the 22 billion over a 6 months period.
Okay. It's interesting to hear the other side as well. Okay, my next question is to Ramraj. This year in May, S&P ruled out an India upgrade. So is that still the case, or what could be the trigger point for an India upgrade?
Yeah, so before I begin, I should just make a disclosure that I think while we are subsidiaries for subsidiary of S&P, I think our analytical processes work completely differently from S&P. So I think their owners just sit on our board, but really we have very little to do with the analytical processes of India's rating. So I can only comment more as an observer of what we see. I think two broad issues which are of serious concern, which clearly definitely that S&P will be looking at, is really the fiscal position and growth. And I think unless we are able to show material improvement on both of this, I think those are the two factors which really will drive I think movement on the rating. The reality is that we are anyway very lowly rated. We are at just about investment grade. Correct. So to that extent, the flexibilities are going to be definitely higher. But notwithstanding that, I think some movement on both of this and some visibility of growth, I think is going to be quite important.
Now, let me come to some local market challenges and the opportunities now, since we are very much interested in India. So, this question is to Amit. So, India, from government securities point of view, we have probably the best infrastructure, best trading